I'm actually not here to tell you what your financial goal should be for 2026. I'm not the type of person to tell you what your problem is and how you need to fix it. And I'm not the type to tell you that the answer to your problems is to just make more money, grind harder, and manifest six figures. No. I want to talk about how bettering your finances actually works. Because most people are chasing numbers, but those same people are not building the systems to encourage or sustain those numbers. Hi, my name is Tiara Alysse, and I share my expertise on finance and government to help you break free of the system. Welcome and welcome back to my channel. In 2026, the way that you hit those numbers is to first invest and have an A-plus stock portfolio. Our dollar is subject to the restrictions of inflation. Inflation causes the prices of goods, services, and necessities to rise, which diminishes the purchasing power of money. Investing allows your money to potentially earn returns that exceed the rate of inflation. Even if everyone else is losing money, you're still gaining. You might think saving does the job and you don't need to invest. And while saving is important, yes, real wealth and stability is built from working, not you working, it working. Investing gives your money a job instead of lazily sitting in your savings account or disappearing in your checking account. That job is to continue to grow without much supervision and create opportunities that will further fund your lifestyle. The most important effect of investing is the effect of accumulation, otherwise known as compounding. Your money generates earnings, and those earnings generate earnings, and those earnings generate earnings. Investing puts exponential power on something that was originally just adding and subtracting. On top of all of that, in comparison to real estate, starting a business, or investing in bonds, investing in the stock market requires much less capital. Liquidity and available cash is much higher at any given time. Effort and maintenance is much lower, and it's much easier to diversify into different types of stocks than different types of buildings, different types of businesses, or different types of bonds. Stocks overall are the most efficient vehicle for wealth creation over time, and it's literally accessible to everyone. An A-plus portfolio is measurable, is excellent, and it's kind of boring. An A-plus stock portfolio does a few specific things. It averages 10% or more return per year over a full market cycle. It beats inflation and builds wealth. It keeps volatility under control, ideally 20% or less. It avoids those gut-wrenching drawdown periods where everybody's panic selling. Most importantly, the returns are consistent. It's not just a few lucky swings or one good year. Your portfolio must perform even in risky cycles. If it only performs well under perfect market conditions, it's not that strong. A lot of people think a stock that has low returns is destroying your account. Low returns does not destroy your portfolio. Risk does. You do not want to be invested in a company that does not compensate you adequately for all of the ups and downs you had to endure for that year. When you start adding companies to your portfolio, these are the types of companies you should look for. You're looking for a technology or digital infrastructure. We're in a digital world, whether you like it or not, so you're looking for companies that function as the digital operating system for the global economy. This is going to be your growth driver. The second type of company is your consumer staples company with pricing power. This company has recession resilience, recurring revenue, and consumer loyalty so strong that they can raise the prices and they will not lose customers. This is going to be your defense against bad news cycles. Third company you need is a healthcare company that has longevity and insurance structures. The earnings consistency here comes from healthcare payments. This stock should also have pricing power, but it shouldn't come with the risk of unreliable drug trials or the potential miracle of world hunger curing patents or anything like that. This is going to be your dividend payer, your cash cow for your income. Fourth, you want the financial systems that run money itself. They have to have balance in the areas of credit, liquidity, assets, and risk. We want the financial companies that thrive even during crisis. And this company is going to tie all three of those systems together. This type of portfolio would outperform the S&P 500, which is great. That is a market index which tracks the top 500 companies in the country. If you don't know where to start there. However, it's not optimized. The S&P 500 is market cap weighted instead of defense weighted. So if the top 10 companies in the country, which are all tech stocks by the way, are all experiencing some sort of shortage, like the chip shortages of 2025, then the entire S&P 500 index is going down, which means your entire account is going down. For what, when you could have just diversified in the first place? An A-plus portfolio intentionally balances growth, defense, income, and capital preservation. It doesn't have to be a lot of companies. 4 to 5 companies will do. Make sure you're following me on Instagram and TikTok to see exactly what's going in my portfolio and what you might be able to include too. Thanks for watching. See you soon.